Hey traders, it's Friday and it's the Friday before the US election, and I have the one and only Jim Welsh from Macro Tides joining us
Thank
today.
God there's only one.
There is only one, but boy, we're gonna rehash this election and the price action ahead of it. And
Yep.
how nervous are you getting right now? And what are you telling your clients as far as like how to protect themselves? Because this is gonna be a berserko election and probably some crazy moves, right?
Yeah. I mean, again, I don't think we're going to have a resolution on Wednesday morning. I think that interjects some volatility all by itself. And I think when we do get supposedly the outcome, again, I'm very skeptical that the losing party will accept it. They'll blame it on, well, Trump obviously will blame it on cheating and the Dems, like they did in 2016, said Trump was an illegitimate president. It was because of Russia. I mean, again, unfortunately, we've gotten so divisive, Blake, that I just don't think we're going to get, even if we get a resolution, we're not going to get an emotional resolution
Well,
and clarity and
yeah.
like, okay, let's put this behind us. No, that's the thing. So normally when markets look forward to an event, the event happens, it gets behind us, and now we can move forward. I just don't think that that's likely in the case of this election.
Well, it kind of brings up your first slide that you brought here with Martin
Yeah.
the late great Martin Luther King. Explain to us what you mean by this. I mean, I think it's pretty much makes sense, but why'd you
Yeah,
bring
yeah.
this
Well,
up?
I think basically, it's a great statement. Uh, we need lightness. And the point, I just made is that I think we're going to have this election, and it's not like we're going to see light drive out all the negativity that we've seen leading up to the election. And, to get a little further off mark here, but the best definition of love that I've ever heard was by the Dalai Lama. And he said, love is the complete absence of judgment. And when you think about that, if all we see is you're a Democrat and you're a Republican, and we attach negativity to those labels, we're going to judge others. And I think, unfortunately, that's where we've gotten to, where judgment is the order of the day. And, in terms of love, that means, in my view, absence of judgment. We're not going to get, I don't think we're going to get to that place, unfortunately, Blake, no matter what happens in the election.
All right. Yeah, I would tend to agree with you on that. You brought the next chart, and I'm gonna
Yeah.
bring it up right now. The FOMC will cut by a quarter. Are you sure about that?
Yeah. Yeah.
Okay.
And I wrote that in my letter this week, and in the monthly November macro tides. I think the Fed is going to cut by 25 basis points. Now, the jobs report maybe gives them a little bit more cover. I think markets are responding a little bit to that. But, they cut by 50 basis points at the last meeting, not to cut at 25 at this meeting after indicating with the dot plot that they would. I think would be an admission that, uh-oh, we made a mistake. I don't think that they don't want to give that impression. Number two is there's a good number of FOMC members who believe that even after that 50 basis point cut, that the funds rate is still comfortably above the neutral rate and therefore requires more easing. So and the inflation data hasn't come in any way that would give them a sense of alarm. So my take is they're going to go 25 basis points. The focus will be on what Powell says in his press conference. And I think it's just he'll repeat kind of what he's been saying, that we've made tremendous progress. The risks to the economy and unemployment and inflation are pretty much equal. And therefore, because of the the still relatively tight funds rate that justified us cutting. And, he won't give any indication of what's going to happen at the December meeting.
Okay. All right. Yeah, that makes sense. Unless the equity markets are down 20% following the election, right? Maybe things might change. But well, okay, then speaking of that would be a surprise. But
Very
speaking of
much.
surprises, your next chart was the surprise index. Now,
Yeah,
you say that's topping. Why do you say that's topping, Jim? I mean, to me, it looks like it's trending higher.
it is. It is. But if you look off to the left, you can kind of see getting above 40. So we're almost up to plus 40.
Yeah.
It kind of stalled. And could it keep going to 60? Yeah, it's possible. But again, my only point was a few weeks ago, we showed this in light of the dollar, in light of Treasury yields. At that time, it's like it's going to keep going up, which should be supportive of the dollar, probably push Treasury yields up. But at some point in time, what happens is, again, let's explain it really quickly. The economic surprise index is calculated by looking at actual data compared to forecasts. So when data starts coming in weaker than expected, as it did during May and June and July into August, remember we had a pretty ugly employment report then. The S's were higher, so the surprise index went down. Well, because of that weaker data, analysts then cut their future forecast for incoming data, which makes it easier for the actual data to come in a little bit better. And that's what we've seen over the last 6 weeks. So my only point is this improvement in the data are getting Wall Street economists to increase their estimates for GDP and retail sale. I mean, just all the data points start to get up. And then that makes it a little bit easier for the data points to miss a little bit. Now, we can forget about the employment report. We talked about this. I've written about it that, it was going to be a really muddy, 12,000 because of the hurricanes and so forth, and which is absolutely appropriate to kind of overlook this number because of that impact. At the same time, I will point out that the 2 months prior, before there were hurricanes involved, the number of jobs were cut from 413,000 to 301. That's a 27% haircut that had nothing to do with the weather. So remember, after the last jobs report, people were like, oh my God, the economy's really good. The labor market's fantastic. Hey, the numbers that have been coming in, even after those revisions, 150,000 a month, that's a decent number. But my point is just the expectation or the impression people got after that last number especially was, oh my goodness. And it's right to dismiss this number that we got this morning because of hurricanes. But, ironically, what's going to happen, Blake, is the employment report is going to cause the surprise index to tick down. Why? Because people were looking for 100,000 and it came in at 12.
Right. Yeah.
All
Yeah.
right.
That makes
So,
sense.
I'm looking at this as like, all right, when can we expect a more probable pullback in the dollar, bottom in Treasury yields? This is going to have to roll over.
All right.
Now,
Well,
we're getting up
speaking
to
of
the levels that I think that's more likely to happen, but obviously, to your point, hasn't happened yet.
right. And speaking of the dollar, I mean, this is the dollar index. That's your chart that,
Yeah.
Obviously, I tend to believe, Jim, the dollar move here, here to here, whether we go up or whether we go down is going to be a binary event following the election. What are your thoughts? I mean, technically, what do you make of this?
I'm looking for more choppy sideways before it pulls back to 102.
Oh, so if it pulls back to 102, I mean, that would mean you are a Harris supporter. Dang it. And I knew it. I knew it all along. So, no, but technically, why do you say it should head lower from here? But
Well, first
because
of
if
all,
if it's a Trump presidency, theoretically, tariffs and probably risk aversion, you could probably sprinkle that in, is probably going to end up being pretty good for the dollar, I would think.
yeah, and less regulation, because regulation has soared under President Biden. and that would be rolled back. You'd have more M&A activity and so forth. But that's partly why the last 2 weeks we've seen the dollar get legs. Why we've seen Treasury yields move up is people are like, hey, the betting polls are telling me that Trump's going to win, and they feel very certain about that. My only point, just looking at this technically, was that I think this is a retracement rally from the 106.52 down to the 100 level. We retraced 618 of that decline at 104.09. We got a little bit above it. When we talked a week or two ago, it was like, I think we can push a little bit higher based on the trading off on the left-hand side. And now I think we're starting to see the beginning of a top being made. The highs a few days ago weren't confirmed by the RSI. The 5 and 13 exponential moving averages are starting to pinch. We're getting closer to where a crossover is likely. Whereas a week ago, 2 weeks ago, I'm like, hey, the gap is so big, that implies choppiness. And we've obviously started to see that. So I'm just looking at this technically, that even if the dollar was ultimately going to be going higher, if I was a big dollar bull, I'd be like, okay, let's look for a pullback. 102 seems to be a reasonable guess. And then then it's going to go higher, but I'd still be looking for a pullback. So I'm just looking at the chart, the retracement. I think the odds favor a modest pullback. And then, how that pullback unfolds will tell us a lot. I'm still of the mind that next year, the dollar will be trading below 100 and has the potential to drop to 95.
Harris supporter. I get it. Okay. Just kidding. Just kidding, Jim. All right. So the next chart that you brought up here is going to be gold. So tell us a little bit about gold, because it's finally rolled over and it's turned bearish. I'm joking. It hasn't done that. It's just been.
No, it really hasn't done that.
It's just been maintaining its highs.
The setup is there, as I pointed out like 2-3 weeks ago. Positioning had gotten very extreme in terms of the number of contracts that are long gold. All right. Yeah. At the same time, as I've repeatedly said, the 5 is above the 13 moving average. The decline from 2684 was an ABC. We held the blue trend line, which is why I said we're going to see another new high. But my cautiousness or expectation that, hey, we're nearing a top here, hasn't been proven correctly yet. The 5 and 13 are pinching. You can see the RSI at the bottom of the chart. You've got not one, but two now negative divergences, but we need to see, obviously, actual price weakness come in. I think it's at some point in time, I think gold is going to pull back to 2,600, 2,620. And then I think it's going higher. So all along the way, Blake, when I've expected pullbacks, it's been, yes, after this pullback, we're going higher. And I think we're still in that mode. That, in other words, the bull market's intact. Now it's just a question of, from a tactical standpoint, is there going to be a pullback to provide another buying opportunity? And so far that has not unfolded as I've expected, but the jury is still out.
All right. Sounds good. I mean, it's the insatiable bid. I've got to assume that maybe we'll get a little bit of reaction after the election, and figure out what the next move is here. All right, the next chart you brought are Treasury yields following crude oil, which I find interesting. What is this supposed to mean?
Well, what you can see is the correlation between crude oil and the 10-year Treasury yield. Has been pretty decent, pretty tight. Not perfect, of course, but the swings on balance have moved together. And what we've obviously seen is crude oil has dropped, which is the blue line, pretty significantly. And yet Treasury yields have continued to go up. And there's good reasons why that's happened, in terms of the economy, expectations of Trump, the term premium, which fluctuates. I discussed this in the November macro tides, has gone from like a minus 45 bips to a plus 45 bips. So you've had this huge swing, Blake, in the term premium since mid September. And all this implies to me that the likelihood here is we will see at least a rebound in Treasury bond prices and a decline in Treasury yields coming. And the correlation with crude oil is supportive of that.
All right. Okay. Well, hence comes your next chart, which is actually TLT, which you've told us the last couple of weeks that we should be finding a bottom soon. So
yeah, and so far all we're doing is we've begun, if you will, what I would say is the bottoming process, in the sense that we're doing this chopping stuff. You're forming what potentially is an inverse head and shoulder. The red horizontal line is at $93 on TLT. A close above that, I think, projects a rally back up toward that wave 4 of lesser degree at 95.62. So somewhere between 95 and 96. And then we'll see. You got 5 down from the high at 101.84. What that implies to me is we're set up for a rebound in TLT, but we're likely to see another pullback after that rebound. And so to me, it's taking this one step at a time. Right now, I think the odds are favoring that we'll see a low put in TLT. Treasury yields are topping out. We're going to get a rally back up and Treasury yields will dip. And if indeed that happens to 95, 96, then it's kind of like, okay, watch the kettle and decide whether or not to lighten up at that price level or not. And, the determinant is going to be what kind of economic data we get to be supportive of an additional move. So this is like a technical rebound to retrace the $10.50 decline TLT's just experienced. And that would imply, like I said, 95, 96. Even if you get a 3.82% retracement of that decline, gets you up above 95.
all right, sounds good. And Jim, so the next chart you brought is something you don't bring in all the time. This is apparently from your weekly technical review.
On Monday.
Okay, tell us what this means, and tell us how we can get our hands on a weekly technical review.
Jim Welsh Macro at Gmail or macrotides.com. So in Monday's report, I went through and looked at the chart of the semiconductor index on the left-hand side. And my point was that you had these big mega cap stocks coming out with earnings this week, but that Advanced Micro Devices report and Intel might have more bearing on what actually transpires. So on Wednesday, the SMH was down even as the S&P was holding up, and then they had another break. So on Monday, I think a drop to 240 or below is coming in SMH. Got very close yesterday, and a drop to near 5,700 is coming. And there was a close below 2762. My assumption was that if we got in close below 2762, that would imply more weakness. Yeah, we got it for a few hours yesterday. If we close back above 2762, that kind of looks like, okay, you had this, quick shakeout, and now you're back. My conclusion, and when we go to the next chart, Blake, because we talked about this last week, one of the indicators that I came up with is the daily indicator, which is the bottom panel. And it compresses advanced declines, new highs, new lows, up and down volume. And what I pointed out is when it gets below minus 40, you're usually at a short-term low. And where it was last Friday, the expectation was going to get a bounce. We did. The 30-minute chart that I talked about last week in terms of, gave a buy signal. I think it was 5804 or something like that. That turned negative at 5830, so just before the dump off yesterday. But the sell-off yesterday took the S&P to a lower low, but you can see that daily indicator isn't as negative. And if we look off far to the left, back in May, something similar happened where you had a spike down, a bounce, the S&P went to a lower low, but the internals weren't quite as negative, which is why the daily hit a higher low. What this suggests to me is the decline from 58.78 is another like ABC. I think the S&P, based on this, is likely to go to a new high.
I knew you were a Trump supporter. I knew it, Jim. I just knew it.
I'm going to do my Linda Blair, thing where my head swivels like, oh, he's Harris. Oh, he's Trump. Oh my God.
I'm just
no,
kidding. I'm totally joking. Obviously
Of course.
I have my assumptions on what will happen in a Harris presidency or a Trump
Yeah,
presidency, and I'm just
having fun
I'm
with
just
it.
letting it all bleed out right now ahead of the election. So,
Well, then you must be in favor of Tampon Tim, letting
that
it all bleed out.
I
Bada
okay.
bing, bada
All
boom.
right,
I'm
enough of
sorry.
that. So Jim, let's talk really quick, since the next week we obviously have US elections. It's gonna overshadow pretty much everything. But is there anything else that we need to be paying attention to from a macro point of view that you think of? I mean, I know like the ISM services data will be out next week. We'll have the Bank of England's meeting next week. I mean, but is there, and I'm sure there's actually some, decent earnings. I know we just got past a bunch of great
the
earnings
big
this
ones.
week,
Yeah.
but is there anything out there that you're like, oh, wait, the election's one thing, but there's something else we need to be paying attention to?
Well, the FOMC meeting, and
Which is like the day after the election,
the
right?
day after, no, I mean, I think if we exclude that the election was happening, we would be continuing to focus on economic data, both here and abroad. Obviously, the FOMC meeting. So to me, it's kind of like I wouldn't be taking my eye off that other stuff at all, because I think the key to understanding where the markets are likely to go is continuing to get a feel for what the economy is going to do. I thought we would see more weakness than we have, obviously. I was wrong. I will say that I think I didn't fully appreciate a few months ago the impact of 6.4% deficit and the amount of government spending that has been supportive of the economy. At the same time, the unemployment rate ticked up, but it's still relatively low. Wage growth continues. So there's underlying things that have proven, if you will, more persistent than I thought. So for me, I'm going to continue to focus on economic data points, because I think ultimately that's what really will drive markets once we get past all this election stuff and noise, and especially as we get into next year. So that's going to be my focus point, because I think ultimately that's what caused the tune in all the markets, what's going on economically.
Right. Okay. Well, Jim, you'd mentioned earlier, but how can our viewers, which this week's going to be a very important week, how do our viewers get a free copy of your
Jim
technical
Welsh Macro at Gmail? And I'm happy
Jim
to I'll
Welsh
send you the
Macro?
November Macro Tide. The one thing I'll put in there, the November Macro Tides, I spent a lot of time talking about China. And they've been obviously in the news because they're starting to do stimulus. What I discuss is what's happening with their demographics and the impact on the overhang of housing. They have enough housing that's empty, built but empty, to house 400 to 450 million people. So unless they remove that oversupply of housing, Blake, housing prices are going to continue to fall. The Chinese, on average, it's like 93% of the people have a house. 20% have more than one. They've got 72% of their net worth tied up in housing. So the net result is they've been cutting back on spending. And if housing prices continue to fall, that's going to weigh on that. So my conclusion is that Xi is going to have to kind of abandon his orthodox communism type of approach that he's really embraced and look at Keynesian type of stimulus. In other words, figure out a way to put money into consumers' pockets, because they need to get the consumer, which their spending as a percent of GDP is 39% of GDP. Ours is almost 70%. And the Chinese have an enormous amount of savings. Our savings rate is like what, 4.5%? Theirs is over 40%. So there's a way for China to convert that huge pool of savings and get it into consumers' pockets. But they're going to have to sell a lot of bonds, use the proceeds of those bonds to buy empty housing. I don't think Xi's going to do that. So I guess my bottom line is China for many years increased global growth because of their growth. I don't think China is going to do enough to really reverse the downward trend and the weighing of their demographics. Their working age population in the next 20 years is going to go from a billion to 800 million. I mean,
Wow.
so it's some really heavy stuff, Blake.
Yeah.
And so again, what am I focused on? I'm focused on that kind of stuff because what will happen over the next 3 to 5 years? I think China is a problem. And a lot of times when leaders are under the gun, what do? They do something militarily to rally the populace. So to me, what China is facing, their demographic problem, increases the odds of China doing something militarily in the next handful of years, just because of that's what leaders do.
Yeah. Well, we're looking at you, Taiwan. All right. Well, Jim, and I hate to say that because I've got relatives there. So, Jim, I want to thank you for spending your time with us. Good luck in the during the election. I hope you. I don't know about you. I'll be sleeping at my desk, but I hope you can avoid that. So.
All right. Well, in the meantime, let's all have a wonderful weekend.
You do the same, Jim. Thank you so much for spending your time with us, and make sure you guys, if you appreciate what Jim does here each and every week, preparing you for the week, make sure you give him a thumbs up. Comment down below if there's anything that you wanted to add to this discussion, and Jim reads all the comments. So thank you, Jim. Thanks everybody for listening in. We'll see you next week.
You got it, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.